Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Black Rifle Coffee Company and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on Black Rifle Coffee. Black Rifle Coffee is a veteran-owned and operated coffee company founded in 2014 by Evan Hafer, a former Green Beret. The company's first location was in San Diego, California, and it quickly became popular among veterans and military families, thanks to its focus on quality coffee and its patriotic branding. Today, Black Rifle Coffee is headquartered in Salt Lake City, Utah, with over 100 employees and several retail stores and a subscription coffee service. Now let's take a look at its price action. Starting with the 1-year chart, we see that Black Rifle Coffee had a CAGR of about -56%. Zooming out to the 5-year chart, we see that Black Rifle Coffee has only been around for 2.5 years with a CAGR of -34%. Black Rifle Coffee has performed horribly since their SPAC listing. Now, let's take a look at the fundamentals. Gross margin is 33%. This is pretty decent. Revenue has compounded at around 51% over the past 5 years and has reached nearly $345 million most recently. Great revenue growth and solid gross margins are a strong start for this company. Looking at cash flow, we see a -150% CAGR over the last 5 years for operating cash flow, while capex has grown at a CAGR of 160%. As a result, free cash flow has fallen at a -195% CAGR. This is just terrible. The company is burning $133 million per year with spend trending to accelerate. Jumping to cash on hand, we see that the company has just $20 million, which means they will run out of money before the end of the quarter unless they take on more debt or issue more shares, diluting existing shareholders. Speaking of shareholders, weighted average shares outstanding have increased at a 21% CAGR since the company went public. This is massive shareholder dilution, going from 45 million shares in Q1 of 2022 to 57 million shares most recently. Black Rifle Coffee has already been mounting pain for shareholders. Now let's view return on invested capital. Return on invested capital has fallen from -28% in 2021 to -50% in 2023. While it is okay for a new company to be unprofitable at first, it is a really bad sign that Black Rifle Coffee is not moving closer to profitable and efficiency over time. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 18 days in 2020 to 101 days most recently, Black Rifle Coffee has gotten a lot less efficient managing inventory and suppliers. Last, let's explore Black Rifle Coffee's debt. The net debt to EBITDA has worsened from -1 in 2019 to -1.6 most recently. For a profitable company, a negative net debt to EBITDA ratio is a good thing. For an unprofitable company like Black Rifle Coffee, a negative net debt to EBITDA value means that the company has growing debt amid worsening unprofitability. This is a very bad sign. The fundamentals of Black Rifle Coffee are pretty bad even if we ignore the unprofitable nature of newly public companies. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Black Rifle Coffee. With less than 10% of its revenue coming from restaurant coffee sales, it will be listed here as a food company instead of a restaurant company. It has a gross margin of 33%. Since the company went public via a SPAC 2 years ago, we will look at the 2-year data. The 2-year revenue per share CAGR is 7% and the 5-year free cash flow per share CAGR is -33%. Dilution has been destroying this company. A return on invested capital of -50% is pretty bad. Next, the cash conversion cycle of 101 days is also bad. Concerning debt, a net debt to EBITDA of -1.6 means that Black Rifle Coffee is both unprofitable and indebted. So from a fundamental standpoint, Black Rifle Coffee is horrible. Now let's switch our attention over to valuation. Given the unprofitable nature of the company, Black Rifle Coffee's value relative to the S&P 500 is difficult to ascertain. Similarly, the price to earnings growth, or PEG ratio, cannot be measured. The good thing about Black Rifle Coffee is that they have had tremendous revenue growth. This demonstrates that there is clearly a growing customer base for the brand. However, management of the company is terrible as they have been spending and expanding with little regard to their cash position and the macroeconomic environment. This is further evidenced by the revolving door of executives at the company. While this company could be an interesting addition to a restaurant portfolio of, say, Texas Roadhouse or Cracker Barrel, I do not see it as a viable standalone business. This is definitely not going on the watch list. Many thanks for watching. What do you think about Black Rifle Coffee and its spending? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.